Welcome to Value Vest Daily, where we analyze the best value and momentum investment opportunities. Today, we're diving into a really powerful idea, a super simple set it and forget it ETF portfolio. We're going to explore how this two-fund strategy has performed historically and, more importantly, how different ways of approaching it could totally change your long-term results. So here's the big question we're tackling today. Can you really build a high-growth, long-term portfolio with just two simple ETFs? A portfolio you can basically set and then forget about? Well, let's find out. All right, the entire strategy we're talking about, it really just hangs on two powerhouse ETFs. These are the engines that are going to drive all the growth we're about to see. So let's get to know them. So on one side, you've got SPYG. Think of this one as your steady, reliable growth partner. It tracks the S&P 500 Growth Index, so you get a piece of about 230 of America's biggest and strongest companies. Then, on the other side, you've got QQQM. This one's more like a laser-focused tool. It tracks the NASDAQ 100, zeroing in on 100 of the most innovative, tech-heavy, non-financial companies on the planet. So what you end up with is this great blend of broad stability and high-octane innovation. Now, let's talk numbers, because this is where it gets really interesting. First off, look at those expense ratios. They are dirt cheap, which means more of your money stays working for you. But the real headline here is the performance. SPYG has a 5-year compound annual growth rate, or CAGR, of almost 16%. Now, CAGR is basically the average yearly return if you smoothed out all the bumps. And QQM? It's even a little higher at nearly 16.5%. That's the kind of historical power we're looking to tap into. And the strategy itself? Honestly, it couldn't be any simpler. We're not trying to be geniuses here, timing the market or picking a winner between these two. Nope. We just blend them together. A simple, equal, 50-50 split. And that balance is the secret sauce. It gives you that broad market stability from SPYG mixed with the concentrated tech firepower of QQQM. And when you mix them together, boom, you get this number, 16.16%. This is the blended weighted average compound annual growth rate. This right here is our magic number. It's the engine that's going to power all of the hypothetical scenarios we're about to walk through. So burn this number into your brain because it's the foundation for everything that comes next. So what does a 16.16% return actually look like in the real world? Well, let's tell a story. We're going to follow 3 different investors. We'll call them Jack, Jerry, and Jill. Now, they all start with the exact same portfolio and the same $150,000, but they each make one crucial decision. And that one choice is going to lead them down 3 very different paths. First up, we have Jack. Think of Jack as our baseline, the straightforward, steady-as-she-goes investor. He takes his 150 grand, puts it into our 50-50 portfolio, and he doesn't use any borrowed money, no leverage, no margin. He's just playing the long game, pure and simple. So after 5 years, how does Jack do? His simple hands-off approach pays off big time. His initial $150,000 investment just quietly compounding away at that 16.16% rate more than doubles to over $316,000. That's a 111% return with zero debt and probably very little stress. That's the raw power of just letting the market do its thing. Okay, next up is Jerry. Now, Jerry sees Jack's returns and he thinks, that's pretty good, but how can I kick this up a notch? He decides to amplify his investment. He takes his $150K and borrows an extra $50K on margin. So now he's got a total of $200,000 in the market. He's taking a calculated risk. So, did Jerry's gamble pay off? You bet it did. His bigger $200,000 investment grows into a much bigger pile of money. Even after he pays back the bank almost $27,000 in interest, his final take-home equity is nearly $400,000. His total return? A massive 165%. That's over 50 percentage points more than Jack. That moderate use of leverage really worked out for him. And finally, we've got Jill. Jill is the most aggressive of the group. She looks at this whole thing and decides she wants to maximize her potential returns. So she borrows $75,000 on margin against her $150K, which means she has a grand total of $225,000 working for her in the market from day one. And Jill's aggressive play? Well, in this story, it led to the biggest reward of all. After 5 years, even after paying over $40,000 in interest, her net equity soars to over $437,000. That's a total return of an absolutely incredible 191%. She has nearly tripled her initial investment. When you see it laid out like this in a bar chart, it's just so clear, isn't it? On the left, you've got Jack's fantastic, solid return. In the middle, Jerry's calculated risk gives him a huge leg up. And then all the way on the right, Jill's aggressive use of leverage leads to the biggest pot of gold. The visual makes it obvious. Leverage can massively amplify your results. But, and this is a huge but, with greater reward always comes greater risk. And that brings us to the most important part of this whole discussion. You can't just chase after Jerry's or Jill's results without also adopting their discipline. To get that reward, you absolutely have to manage the risk. So let's look at the guardrails each of these investors needs to have in place. For Jack, risk management is pretty chill, honestly. It's the classic good habits approach. He just needs to rebalance once a year to get back to that 50-50 split. He should use dollar cost averaging, investing a set amount regularly, keep a cash buffer for emergencies so he never has to sell at a bad time, and maybe most importantly, just tune out the day-to-day noise and think long-term. It's a genuinely low-maintenance way to invest. Now, Jerry's world requires a lot more attention. He needs to set hard rules, like capping his margin borrowing so he doesn't get overextended. He might use stop losses to automatically sell if the market takes a dive, protecting him from a major wipeout. He also has to keep an eye on interest rates, because if they go up, his loan gets more expensive. This is no longer set and forget. It's more like set and actively monitor. And Jill? Well, she has to be the most disciplined of all. She needs a dynamic plan, maybe using some profits to pay down her loan as her portfolio grows, which lowers her risk over time. She'd need to set tight alerts for any big market drops and, absolutely crucially, have a cash reserve on standby, ready to go in case she gets that dreaded margin call. Her high-reward strategy demands constant, high-level attention. And this really gets to the heart of it. Leverage isn't free money, and it's not a cheat code. It's an amplifier. It's like a magnifying glass. In our story, it magnified gains because the market was on our side. But you have to remember, that magnifying glass works in both directions. In a down market, it would have magnified the losses just as powerfully. Understanding that is absolutely non-negotiable. So, after looking at Jack, Jerry, and Jill, what's the big takeaway here? What does this all mean for you and your own path to growth? Okay, and before we go any further, I have to say this, and it's really important. This is for educational purposes only and is not financial advice. All of these numbers are hypothetical projections based on historical averages, and past performance is absolutely no guarantee of what will happen in the future. Please do your own research. And that brings us to the final and really the most important question of all. Which investor are you? Are you a Jack, a Jerry, or a Jill? There's no right or wrong answer here. The only right answer is the one that aligns with your goals and, crucially, lets you sleep at night. Knowing yourself and your own tolerance for risk is the real key to long-term success. If you found this breakdown valuable, do us a huge favor and please subscribe, like, and share Value Vest Daily. We put out these learning opportunities all the time to help you make smarter decisions before you put your hard-earned money to work. And one last thing. We really want to know what you're curious about. Is there a specific high-risk, high-reward idea you want us to do a deep dive on? Let us know in the comments below. We'd love to hear from you. Thanks for watching.